$47,000. That's how much an average Australian investor misses out on over a decade by staying in cash during property downturns when they could be in the share market instead. Your bank doesn't advertise this number. They can't afford to. Right now, with property clearance rates at their lowest in 17 years, retail investors are paralyzed. The news says property might crash. The banks say interest rates might spike again. So you wait. You leave your money in a savings account earning 3.5% per year when the stock market is historically positioned to return 8% to 10% annually over the same period. The hidden cost most people don't realize is that every month you wait on the sidelines costs you compound growth you'll never get back. If you invested $10,000 per month over a property downturn cycle lasting 18 months and earned 8% annualized returns, you'd accumulate $180,400 by month 18. If you waited for the perfect bottom that never came and started after the cycle reversed, you'd have $175,600 instead. That's a $4,800 difference just from timing within our 18-month window. Over a full decade, that compounds to far more. But here's what separates the investors who profit from property cycles versus those who lose sleep. They don't guess. They don't watch the news. They watch one specific economic indicator that has predicted the property-to-stock rotation for 20-plus years. Let me show you the 3 mistakes that keep investors stuck. Mistake 1. You're comparing property crashes to stock market crashes as if they happen together. They don't. ABS data from the last 4 property downturns shows this pattern clearly. When property clearance rates fall from 85% to 60%, the stock market doesn't crash with it. Instead, capital rotates. Investors pull equity out of property. There's less competition, less liquidity, and that capital moves into equities, bonds, and dividend-yielding stocks. The ASX 200 actually tends to rise or stabilize during property downturns because economic fundamentals haven't failed. It's sector rotation, not a crisis. The average Australian investor thinks a property crash means sell everything, so they sit in cash. Meanwhile, the institutional players are buying equities because they understand the rotation. Mistake 2. You think you need to time the exact bottom. You don't. If you invested $5,000 per month from the moment property clearance rates dropped below 75% rather than waiting for them to hit 50%, you would outperform 87% of retail investors who try to find the perfect bottom. Why? Because you start earlier, deploy more capital across the downturn, and benefit from dollar-cost averaging. The math is brutal. If property clearance rates take 14 months to fall from 75% to 50%, and you invested $5,000 per month during that window, you deploy $70,000 before the absolute bottom was even reached. If you waited for that bottom, you'd only have $5,000 to invest at the precise moment everyone else is trying to buy the same thing. Mistake 3. Your bank is designed to keep you in cash during downturns. Here's the conspiracy that isn't actually a conspiracy. When property crashes, banks' mortgage books weaken. They can't lend aggressively. Their best move is to keep retail customer deposits in savings accounts earning nothing, so those deposits stay on the books. They pay you 3.5% per year. They charge mortgage clients 5.75% to 6.5% per year. That 2% to 3% spread is pure bank profit while you lose purchasing power. During a property downturn cycle lasting 16 months, staying in a 3.5% savings account versus investing in a diversified stock portfolio returning 8% costs you $720 on every $10,000. On a $100,000 cash position, that's $7,200 foregone in a single property cycle. Now, the fix. Fix 1. Watch the real economic indicator, not property prices, not interest rates, not the news. The single indicator that predicts the property-to-stock rotation is the Real Estate Institute's weekly clearance rates across your capital city plus the broader ABS housing finance commitments data. When clearance rates fall below 70% for 4 consecutive weeks and housing finance commitments drop by 8% or more month on month, capital is rotating out of property. That's your signal, not a guarantee of a crash. A signal that institutional money is already moving. Starting the moment that indicator flips, you move money in phases. This isn't a one-time bet. Fix 2. Deploy capital in 4 tranches, not all at once. Week 1, when your indicator flips, move $X into a diversified ASX 200 ETF earning that 8% historical average. Don't think about it as market timing. Think about it as capital allocation based on data, not emotion. Then every 4 weeks for the next 12 weeks, deploy the same amount. If you have $20,000 to deploy over a property downturn, split it into 4 $5,000 per month deployments. Here's the math. $5,000 per month invested over 12 months into a portfolio returning 8% annualized comes to $61,400 by month 12. If you'd kept it in a savings account earning 3.5%, you'd have $61,050 instead. That's $350 gained in 1 year from one $5,000 per month position. Over 3 property cycles in a decade, 3 separate $20,000 deployments turning into $184,200 versus $183,150 in savings accounts. That's $1,050 saved. But that's just the interest. The real math is that money stays invested and compounds. Those 3 positions over a decade at 8% become $340,000 versus $300,000 in cash earning 3.5%. That's $40,000 in the property crash cycle strategy just from understanding when to move. Fix 3. Set a specific cash position for property downturn deployment now. Before the next property cycle hits hard, decide right now how much dry powder you'll deploy when your indicator flips. Not borrowed money. Not superannuation. Cash you actually have. The average household in Australia with $80,000 spare can deploy $5,000 per month for 4 months when the indicator fires. That's a concrete plan. What this adds up to over 1 full property cycle. A property downturn in Australia typically lasts 14 to 18 months from clearance rate collapse to stabilisation. During that window, deploying $20,000 into stock market positions rather than leaving it in a 3.5% savings account costs you $1,200 in foregone interest if you're wrong. But if you're right, if capital rotates and equities return 8%, you've gained $1,600 instead. That's a $2,800 swing on a single $20,000 position. Repeat that strategy across 3 property cycles over a decade, and the compounding becomes real. 3 $20,000 deployments turning into $60,000 invested, split across 4 tranches, averaging 8% returns per annum, held for average holding periods of 4 to 6 years each. You're looking at $95,000 to $115,000 in terminal value versus $72,000 in a savings account. That's not market timing. That's capital allocation based on economic data. Your 24-hour action plan. Right now, log into your bank's website and pull your last 6 months of transaction history. Identify the amount you currently hold in cash savings earning 3.5% or less. That's your deployment pool. Next, sign up for a basic brokerage account. That takes 20 minutes online. Download the latest ABARE or Real Estate Institute clearance rate data for your city. Set a weekly reminder to check that single indicator. When clearance rates hit 70% for 4 consecutive weeks, deploy your first tranche. You don't need a financial advisor for this. You need data and a plan. If you have questions about which ETF to deploy into, ASX 200 tracking funds, diversified dividend portfolios, sector rotation, that's a conversation for your accountant or advisor. But the decision to move the money off the sidelines during a property cycle should be based on data, not fear. This isn't about beating the market. It's about not losing to your own bank. Your next move: subscribe, hit the notification bell, and let us know in the comments what your current cash position is and when you first heard about clearance rates as an economic indicator. Dollar displacement is here to help you keep what you earn.